Hello and welcome to FAR-6. So we're going to start FAR-6 with the fun and exciting concept of business consolidations, where we look at how the parent consolidates the financials of all its subsidiaries on each reporting date. So guys, if you recall, way back in FAR-3, I introduced to you the concept of investments, where I said if the investor, he owns less than 20% in the investee, such that he's got no influence at all. So he's got no influence. He could use the cost method, or he could use marketable securities method if the securities of the investee were trading in the market. Now, if the investor brought up a stake, he owned 20% to 50% in the investee, such that he exercised significant influence over the investee. That's when he used the equity method. So this was significant influence. And the relationship here, what we're looking at is investor-investee relationship. Now, if the ownership is more than 50%, then it becomes an acquirer-acquiree relationship, or we could call it a parent-subsidiary relationship, such that the acquirer or the parent exercises control over the acquiree or the subsidiary. So this is control, and that is when the parent, they consolidate the financials of the subsidiaries into their own financials. Because they control the subsidiary is an extension of the parent. This is called the economic entity concept, and we're going to use the acquisition method because we're talking about acquirer and acquiree here. Now, the way it happens is, let's say we got a lot of years here, drawing a timeline. Let me call it 1231 year 0, 1231 year 1, 1231 year 2. Now, when the parent acquires over 50% stake in the subsidiary, such that the parent, they've got control over the subsidiary, during the year, they're going to account for this investment using the cost or the equity method. So guys, though the parent has control over the subsidiary, during the year, in their books, they're going to account for this as an investment using the cost or the equity method. So let's say the acquisition happens at this point. The parent owns more than 50%. During the year, it's going to be cost or equity method on the parent's books. Now, at year end, at each reporting date, that's when the parent, they're going to consolidate the subsidiaries' financials into their own financials. But this consolidation does not happen on the parent's books. It happens on a separate worksheet. So on the parent's books, it's still an investment. But on the worksheet, that's where the consolidated numbers are created. So during the year, you're going to use either the cost or the equity method. It doesn't matter, because ultimately, whatever method you're going to use, it's going to reverse off when you do the consolidation. So the consolidation happens on a separate worksheet. So you could say, you got the junior accountants there creating all the accounts in the parent's books. Then we expert CPAs, we step in and we do this consolidation, not on the parent's books, on a separate worksheet. So again, let's say 1st Jan next year, you're again going to have the parent's books, and they're going to use cost or equity method on the parent's books. And we'll step in again at the end of year 2, and we'll consolidate on a worksheet. So what we'll do right now is we'll look at an example on your book where we have investments by the parent into the subsidiary, says that they have over 50% stake control. And first we look at pre-consolidation numbers, the numbers that the junior accountants, they're going to prepare, and then we'll step in and we'll do the consolidation on that worksheet. So let's look at the numbers there. You got balance sheets for the P company and the S company. You got assets, liabilities, and equity. So let me do it here. We got the parent and sub. So generally, whenever you have P and S, P stands for parent, S stands for subsidiary. We've got cash, accounts receivable, we've got inventory, and they've got equipment, PP&E. The parent has got cash, $1,000. Subsidiary's got only $100, smaller company. Receivables of the parent, $1,500, subsidiary $200. Parent's got inventory, $500, subsidiary $100. Equipment of the parent, book value $8,000, subsidiary $500. Total assets of the parent, we got $11,000. Subsidiary total assets is $900. That's the asset side of the balance sheet. Then let's look at liabilities. Both of them got payables and bonds payable. So accounts payable, parent $800. Now, since it's a worksheet, whenever we have credit, we're going to use a negative number, so it gets easier for us to understand. For subsidiary, they got payables of $50, bonds payable. Parent, they got $1,200 of bonds. Subsidiary's got $250 of bonds outstanding. So this gives us total liabilities. For the parent, it's $2,000 of liability. For the subsidiary, it's $300. Next, let's look at equity. So they got common stock, they got APEC, and they have retained earnings. Now the parent has got common stock $1,000, they've got APEC $3,000, and they have retained earnings $5,000. So that's total equity of the parent. $9,000. Book value of equity, $9,000. Now, let's just quickly check if everything's okay on the parent's balance sheets. The accountants have done a good job. So, we want to be sure that assets minus liabilities, that's equity. 11,000 minus 2,000, is that 9,000? Yes, it is. Good job. Done. Let's look at the subsidiary now. So, you got subsidiaries having equity $100, common stock $100, APEC, and they've got retained earnings of $400. Calculates to $600. Again, 900 minus 300. Does it give us $600? Yes, it does. So all's fine, all's well on the subsidiaries balance sheet. Now, what we are looking at is past journal entries for acquisition and prepare balance sheets before consolidation on the parent's books. If parent acquires if parent issues 150 shares of stock to acquire all of S, and P stock has a market value of $6 per share. So guys, what we are saying is the acquisition here is happening at this point. So at 12/31/X1, this is the point at which the acquisition is happening. And the parent right now is issuing its own stock to acquire 100% of the subsidiary. So the parent is issuing 150 shares of common stock, market value of $6 per share. So that's an investment of $900 on the parent's books. So on the parent's books, we're going to create an investment account. So it's going to be investment in subsidiary, and it's going to be at $900. 150 shares, $6 market value. Now, it'll impact the equity section of the parent because now they're going to have more common stock outstanding. Here, they had 1,000 common stock outstanding. Now, they'll have 1,150 common stock. So, this will be plus 150. The par value, the face value, the stated value of common stock, that's $1 each. The market value, $6. So, the remaining goes into APEC, $750. So total assets 11,000 plus 900, 11,900. Total equity $9,000 plus 900, $9,900. So that's when the parent acquires the subsidiary, investment in subsidiary, by issuing stock. Now look at the next one. The parent purchases S for a cash consideration of $900. So the parent, they've got a lot of cash. They use this cash. They don't issue stock now. They use this cash to acquire all of the subsidiary. So now in that case, there's going to be no stock issuance. And they're going to have this investment in S account, and cash is going to go down from $1,000 to $100. They're going to use $900 of this cash. The asset's going to remain at $11,000. So this is increased by 900, reduced by 900. So this would be the pre-consolidation balance sheet for the parent. And now, so guys, what you could say is the junior accountants, they've got this pre-consolidation balance sheets ready. They have used the cost or the equity method. We don't care, because when we step in, we're going to do a consolidation. So we're going to use a magic wand as expert CPAs, and we're going to create consolidated financial statements. So let's get to the book, look at it, and I'll come back and I'll teach you all the tricks, all the techniques of consolidation. We're looking at business combinations and consolidations on page 2. Highlight combination refers to mergers or acquisitions of business entities. So when there is a merger, only one legal entity survives. But when there is an acquisition, there is an acquirer and an acquiree which survive as separate legal entities but are actually one economic entity. And that is why we do consolidations. So draw an arrow from acquisition down to consolidation. And highlight consolidations refers to consolidation of financial statements of the acquirer and acquiree under the economic entity concept. We know that if the investor owns less than 20% stake in the investee, such that the investor has no influence over the investee, the investor would use the cost method or marketable securities methods to account for the investment. If the investor has 20 to 50% stake, such that the investor exercises significant influence, then the investor would use the equity method to account for the investment. Now in this section, we are looking at the investor having more than 50% stake, such that the investor controls the investee, and we're going to call the investor, highlight acquirer, and the investee will become the acquiree, or the investor is the parent and the investee is the subsidiary. In such cases, we are required to go for, put a box around, consolidation. Now naturally, this implies that the acquirer has underlying control over the acquiree. The parent controls the subsidiary. So this is called the acquisition method, where we're looking at one economic entity. Now, during the year, the parent is going to account for the investment in its own books using the cost or the equity method. So highlight follow cost or equity method on parent's books. But at year end, they're going to consolidate the financials of the subsidiary into their own financials on a worksheet. So highlight consolidate on a worksheet only, not on the books of the parent and subsidiary. Next year again, they're going to account for the investment in the subsidiary using highlight cost or equity method on the parent's books. At year end again, they're going to highlight consolidate on a worksheet only. Moving on to page 3, highlight all subsidiaries must be consolidated. And then highlight unless significant doubt exists regarding the parent's ability to control subsidiary, or highlight subsidiary is in bankruptcy, legal reorganization, or under severe foreign restrictions. Turn on to page 4, where we're looking at the initial investment by the parent into the subsidiary. Highlight investment in sub. So it could be an acquisition for cash when cash goes out of the parent's books, or it could be an acquisition by issuance of the parent's equity. Now we know that during the year, the investment in sub may be accounted for using the cost or the equity method on the parent's books. Now in the next sub-bullet, let's look at costs incurred in the business acquisition. Direct, indirect or general costs are all expensed. So we're looking at legal, accounting, consulting, finder's fees, G&A. Next, costs associated with the issuance and registration of debt or equity securities. Let's say sales commissions paid. These are netted against the proceeds of the stock, and they result in a debit to APEC and a credit to cash, but have no effect on the investment price. So you can look at the journal entry there where we have APEC debit and cash credit does not affect the investment in subsidiary account. Let's go to page 7 and look at the example that we've just started building up on the board. On the second half of this page, you got the pre-consolidation balance sheets of the parent and the subsidiary. And we got two cases here. Case number 1, where the parent issued 150 shares of its own stock to acquire all of the subsidiary, 100% of the subsidiary. And highlight case 2, acquire for cash, where the parent purchased 100% of the subsidiary for a cash consideration. Now, we're going to build up case 2 as we look at many more examples to come on the next few pages. So we've started with an example where we saw the parent acquired 100% of the subsidiary as of end of year 1. And we prepared the pre-consolidation balance sheets of the parent and the sub. And now we're going to look at the consolidation, which I told you is going to happen on a separate worksheet. Now think of consolidation as the parent as the subsidiary presenting themselves as one economic entity. So consolidation means you're going to have parent plus sub consolidated. So the parent is going to say, my assets, your assets, it's our assets now. My liabilities, your liabilities, it's our liabilities now. We are one entity. So that is all about consolidation. Simple and easy. So let's start doing that. So you got the parent, you got the sub, and now we're going to prepare consolidated financial statements. So the parent has got cash of $100. Subsidiary, they've got cash of another $100. So the parent is going to say, my cash $100, your cash $100, our cash $200. My receivables $1,500, your receivables $200, our receivables $1,700. So what inventory? My inventory $500, your inventory $100, our inventory $600. Investment. My investment in you. Now you are a part of me. Guys, can I have an investment in myself? Doesn't make sense. So now when we are preparing consolidated financial statements, we don't want this number, because this is an investment which the parent has made in the subsidiary to acquire the subsidiary's stock. You getting it? So we paid $900 to acquire all of subsidiary stock. So now when we're preparing consolidated financial statements, we don't want this there. We also don't want the subsidiary stock because the parent owns the subsidiary stock. Now investment, that's $900. But subsidiary stock, that's 100 plus 100 plus 400, $600. So they've paid $900 for this $600, but they haven't paid at book value. They've paid at fair value, which is more than this. And if they have paid in excess of fair value, we're going to create goodwill. So guys, this is a business combination and we're going to account for it at fair value. And if the parent has paid more than the fair value for the subsidiary, we're going to create an intangible asset, goodwill. So we need something here. We can't do a simple plus and create consolidated financials. We'll need what we call the eliminating journal entry. So on the consolidation worksheet, we're going to have an elimination journal entry. And I'm going to give you a lovely mnemonic which will help you remember this eliminating journal entry for life. And this mnemonic is caring. So guys, think of the story. The parent, they acquire the subsidiary. They control the subsidiary. The subsidiary, they're not worried, they're nervous. So the parent tells the subsidiary, don't worry, we still care for you. So guys, that's your mnemonic for consolidation, eliminating journal entry. So the way we're going to have it is like this. We're going to have C-A-R-E. So this is the caring with the E. C-A-R-E. We're going to have I and N, and then we're going to have G. So you got to remember this whenever you're preparing consolidated financial statements, because this is your eliminating journal entry on the worksheet. Now C stands for common stock of sub. So we don't want the subsidiary's common stock anymore because we own that. That's not outstanding. A stands for APIC. Now this is again the subsidiary's APIC. No longer outstanding. Subsidiary's retained earnings. So common stock plus APIC plus retained earnings. You could say all this. This is the book value of the subsidiary. Now naturally the parent didn't buy the subsidiary at book value. They paid more than that. They paid some excess. So that's the E. Excess fair value over book value. So you could say CAR plus E, that becomes the fair value. Now, if the parent paid even more than the fair value, that was due to some goodwill. So CAR, that's common stock, APIC and retained earnings of the subsidiary. Book value of the subsidiary. We want to debit that. We want to eliminate that. Equity, that's a credit account. The moment you debit it, it goes off. Excess fair value over book value. So let's say there was an excess valuation of PP&E over book value. We're going to debit it. We're going to increase the value of the PP&E. Because of the business combination, it's going to happen at fair value. Now, if it's even in excess of fair value, that's when we're going to have goodwill on the consolidated financials. So this is all your debits. Looking at the credits. Now the parent, they've made an investment in the subsidiary which they are accounting for using the cost or equity method. That investment number at the end of the year, we want to get it off on the worksheet because you cannot have an investment in yourself. So that would be investment credit here. Now this N stands for non-controlling interest. So I said we're going to consolidate whenever the parent owns more than 50% of the subsidiary. So in our example, we had the parent owning 100%. Now in cases where the parent owns more than 50%, but not 100%, say 80% or 90%, 20% or 10% is owned by minorities, non-controlling guys. That's when you have a non-controlling interest. So we'll look at that in a moment. First, let's understand how to treat when the parent acquires 100% of the subsidiary. So guys, let's put in the numbers from our example there. So now when I'm looking at common stock, APIC, retained earnings, we got the subsidiaries, common stock, APIC, retained earnings, 100, 100 and 400. We got to eliminate that because that's no longer outstanding. That's owned by the parent. So we're going to have $100 here. Let me use the blue pen for this. $100 here and the $100 here and $400 for retained earnings. Now the subsidiary's equity, that's flushed off. Excess fair value over book value. Let's look at the example. It says, using facts from the first example on consolidation, assume that P company or the parent acquired all of the stock of S company in an acquisition on 31st December year 1. Yeah, that's the we're looking at, for a payment of $900 cash. So we already adjusted the cash here. At the time, all of the assets and liabilities had fair values equal to their book values, with the exception of equipment with a remaining life of 5 years and a fair value $100 higher than book value. Prepare journal entry for acquisition and consolidation, and prepare balance sheet after consolidation on 12/31/X1. So the acquisition happened on this date, and we are preparing the consolidated balance sheets as of the same date. Now what they're saying is the PP&E of the subsidiary had book value of $500, but the fair value of this PP&E was $600, $100 excess. So this excess would be $100. So that's $600 for the book value, $100 excess fair value. But they paid $900 for all the stock of the subsidiary. That means there's a goodwill residual, 700 plus 200 of goodwill would have given us 900. So goodwill would be $200 out here. Now the investment number that we got to eliminate from here is $900. There's no non-controlling interest right now. We'll talk about that later. So guys, if you recall, when we did the equity method, I helped you draw a chart. The chart looked something like this. So we had book value, we had fair value, and then we had the purchase price. So you could say the book value is CAR of Caring. The fair value is CAR plus E. The purchase price is CAR plus E plus G. Or this is also equal to the investment plus non-controlling interest. So book value and fair value, the difference here, this is E, excess fair value over book value. Purchase price and fair value, the difference here is the goodwill, G. So this would be a ready reckoner for you, a good tip for you to make sure this journal entry looks all right. So let's look at the numbers here. Got the book value $600. So CAR, that's $600. Excess, this is $100. So the fair value, that's $700. What's the purchase price here? Purchase price is $900. So 900 minus 700, goodwill is $200. So the most important thing you need to know, Caring, that's a journal entry. Now after you've done with the journal entry, you could prepare this chart to understand the flow, and it becomes so much more clearer now. Let us use the numbers on this journal entry and put it on the consolidation worksheet. Guys, the consolidation is not happening on the parents' books. It's happening on a separate worksheet where we're taking the parents' numbers and we're taking the subsidiaries' numbers. We are preparing consolidated financial statements. So looking at the eliminating journal entries here, we're going to have debit and credit for elimination. Let me use the blue pen for consolidation. So when you have the eliminating journal entry, you have Caring, you have CAR. So CAR, and you had debits for CA and R, which was equal to the subsidiaries common stock, subsidiaries APIC, subsidiaries retained earnings. So you're going to have $100 debit here, 100 debit here, and a 400 debit here. And then you have an excess fair value. What's the excess fair value for? That's for the PP&E. The subs PP&E, which is at $500 on their books, is actually worth $600. So you're going to do plus 100 on this. We also had a goodwill being created. So you're going to have a goodwill account on the consolidated financials, not on the parents' books, but on the consolidated financials, we're going to have goodwill for $200. what we had eliminated on the credit side, we had investment $900. So we have 400, 500, 600, 900. 900 on the credit. Good to go. Now simple sum. So once again, my cash, your cash, our cash. My receivables, your receivables, our receivables. My inventory, your inventory, our inventory. My investment in you? No, we won't have it on a consolidated financials. PP&E, my PP&E, your PP&E. But my PP&E is at historical cost, book value. Your PP&E is at fair value because I just acquired you. 8,000 plus 500 plus 100 excess fair value of subsidiary, 8,600. Goodwill. I paid excess of your fair value. So that's why there's a creation of goodwill, acquired goodwill. So we're going to have total assets, which is going to be 11,300. Then looking at the liabilities, my payables, your payables, our payables, $850. My bonds outstanding and your bonds outstanding, that's our bond outstanding. We're bonding together. $1,450. That gives us total liabilities of $2,300. Now, my equity, my common stock, your common stock, but your common stock, I own it. It's no longer outstanding. So it's going to be my common stock, your common stock eliminated. So it's just my common stock, $1,000. My APIC, not your APIC, my APIC, $3,000. My retained earnings, not your retained earnings, that's eliminated. I own it, I bought it, I acquired it. It's only $5,000 here. That gives us $9,000 total equity. So guys, as you can understand, the consolidated financials, they're going to have assets 11,300 minus liabilities 2,300, which gives us equity $9,000. You're good to go. So it was a simple addition, just that we needed to have this eliminating journal entry, and the mnemonic here was caring. So that was your mnemonic which helped you create this eliminating journal entry. And you prepared this chart just to make sure the numbers tied in pretty well. So guys, on the parents' books, they're going to prepare this balance sheet. They're going to have these numbers. At year end, they're going to bring the subsidiaries numbers together. So we're going to have the parents' books plus we'll bring the subsidiaries numbers together. We'll do the eliminating journal entry and prepare consolidated balance sheet. You got to remember this eliminating journal entry. Once again, it's caring. Now, wait a minute. This is exactly what my wife tells me. She tells me that she's acquired me. She owns me. She controls me. But she still cares for me. And I'm pretty sure all you husbands here in the class hear the same stuff from your wives. And when she's around, when she's listening, you gotta say, you're forced to admit that she's so caring. On page 5, we are looking at the eliminating journal entry, and our mnemonic is caring. So the parent tells the subsidiary, I still care for you. On the first bubble there, write CAR and highlight determine book value of the net assets of the subsidiary or the equity of the subsidiary. So you want to eliminate the common stock, APIC, and retain earnings of the sub. Next bubble, write E and highlight excess of fair value over book value of the sub's identifiable assets and liabilities. And underline, new identifiable intangible assets of the sub must also be recognized. So you should be on the lookout for any marketing related intangibles or customer related intangibles, any artistic related intangibles, contact based intangibles, or even technology based intangibles that the sub has. Next bubble, write I and highlight determine the purchase or acquisition price paid by the parent at fair value. Basically the investment in sub of the parent. Next bubble, write N and highlight determine the value of non-controlling interest if less than 100% share. And we'll come back and look at this later. Move down on this page, write G on the last bubble and write plug to goodwill, which is the excess of investment by parent over fair value of the sub. So guys, goodwill is the unidentifiable intangible asset that represents future economic benefits other than that arising from identifiable or recognized assets acquired in a business combination. And the last line highlight if goodwill is negative, record the amount as a gain on the income statement. Move on to page 6 where you have the eliminating journal entry, caring. So put a star there and fill in the bubbles C-A-R-E-I-N-G. So CAR, that's the sub's equity. E, that's the excess fair value over book value. I is the investment in subsidiary. N stands for non-controlling interest if less than 100% is acquired by the parent. G is the residual goodwill. Moving down on page 6, you got this lovely chart which helps you understand this eliminating journal entry, caring, and makes sure that you've got your numbers right on the exams. So where you have book value of the sub net assets or the book value of the sub's equity, right? C plus A plus R. So that's a common stock APIC and retained earnings of the subsidiary. And then you're looking at the excess fair value over book value, right? E. And that gives you the fair value of the sub net assets, right? C plus A plus R plus E. And the excess that you've paid over that, that's goodwill. So write G. And that calculates to C plus A plus R plus E plus G. And write equals I plus N. So that's equal to the credits on your journal entry, which is investment in subsidiary plus any non-controlling interest if the parent acquires less than 100% stake. Get to page 8 where we are looking at an example on consolidation where the parent acquires 100% in the subsidiary at year end. So highlight acquisition on 31st December X1 and the consolidation also happens on the same date. Highlight consolidation as of 31st December X1. So you prepare the eliminating journal entry, put a bracket around that and write eliminating journal entry equals caring. And this is the caring with an E, C-A-R-E-I-N-G. Once you're done with this eliminating journal entry, put the numbers on our chart to make sure they all look good. And after you're done with this, you're all set to prepare the consolidation worksheet. So put a box around worksheet, where you first have the pre-consolidation numbers, and then you make adjustment for the eliminating journal entries. Draw an arrow from where you've written eliminating journal entries to the two columns that you have on the consolidation worksheet. And this helps you get to highlight consolidated financial statements. On the previous example, we just saw the parent acquired 100% of the subsidiary as of year end, and on that same date they consolidated to present consolidated financial statements. So guys, we had the numbers here, we had the numbers in the parent's books as of the year end and the subsidiaries books, and we had our eliminating journal entry caring where we got off the subsidiaries equity. We had excess fair value, goodwill, and the credit was to investment, where we knocked off this investment number where the parent had investment in subsidiary. Can't have investment in yourself. And we created these consolidated numbers. So now that we have our worksheet ready, we are all set to report out consolidated financials. And let's do that on a dashboard. So the CPA is going to come and prepare that worksheet and report the financials. So assets, you're looking at cash 200, accounts receivable 1700, inventory 600, Investment knocked off. Can't have an investment in yourself. 8,600 PP&E, 200 goodwill, gives you 11,300 total assets. Accounts payable for the consolidated entity, 850. Bonds payable, 1450. Gives you a total of 2,300 of liabilities. Equity, 1,000 common stock, 3,000 for APEC, and 5,000 for retained earnings. Gives you 9,000 of equity. Now, this is not the balance sheet for the parent. This is the consolidated balance sheet. Parent plus subsidiary. So guys, we're good to go with presentation of consolidated financial statements, which does not happen for accounting purposes, but what happens for reporting purposes. Now, we look at the next example, where we would have the parent acquiring the subsidiary, 100% of the subsidiary, not at the end of the year, but during the year. Let's say at the beginning of the year. And the consolidation, that will not happen during the year. That happen at the reporting date, let's say end of the year. So it's going to be acquire 100% during the year and consolidate at year end. Looking at the example, using facts from the first example on consolidation as well as the previous example, assume that the acquisition date was 1/1/X2. Here the acquisition date was 31st December year 1. Now the acquisition is happening on 1st Jan next year. The equipment with excess fair value had a 5-year life and goodwill on acquisition is impaired by $25 as of 31st December X2. So now that's a consolidation date. Income during the year for parent was $2,500, for subsidiary was $200. The investment, look at this, is accounted for under the equity method. Now I told you, under the parent's books, you could have cost or equity method, because anyways, the investment number, that's going to be knocked off on consolidation. So the parent, they use the equity method during the year. Then pass journal entries for acquisition and consolidation and prepare balance sheet after consolidation as of 31st December X2. So acquire on 1st Jan X2 and consolidate on 31st December X2. Now, let me do a little bit of a cleanup here. Let me get this off. I'll keep the template intact. I'll just get the numbers off. Let me get there, and again, let me clean up consolidation because we're going to do it all over again. You see the way I'm cleaning it up? That's what they do in real life. They use the last year's template or a previous template and then create new numbers on that. So we got the numbers for 31st X1. Now there's a little bit of change here. Okay. This looks good, yeah. Now, what they're saying is the parent had income during the year for $2,500. Now, let's assume all that income was earned in cash. So, retained earnings would have increased by $2,500 and cash would increase in $2,500. For subsidiary, the income during the year was $200 plus $200 retained earnings for the subsidiary, and their cash would also increase by $200. Now, then you had investment for $900 to start with on 1st Jan year 2, and when the subsidiary earned $200, the parent, they owned 100% of the subsidiary. They're going to add $200 to their investment, and they're going to have equity in earnings $200. But they're saying this equipment which had this excess fair value of $100. So if you remember, this equipment of $500 which the subsidiary has, the fair value of this was $600. Now subsidiary did not depreciate it when they did the retained earnings, because on their books it was for $500. Now we're going to depreciate that excess over 5 years, depreciate that $100 over 5 years. So if you remember the equity method, FAR-3 guys, so this becomes minus 20, and instead of 200, this becomes 180 now. Then they had impairment of goodwill by $25. So goodwill was for $200, got impaired by $25. So this became 155 now. So this became, equity earnings is 155, even this one would calculate to 155. Now, they will not ask you to do all this in the CPA exams. I'm doing this because I'm trying to build up from the previous example that we've had. So let me clean up and put new numbers in place here. I'm back. So this one becomes 2,600, cash 2,600, cash for the subsidiary becomes $300, investment becomes 1,055. Retained earnings of the parent, that becomes 7,655. And retained earnings of the subsidiary, that becomes $600. The totals would naturally change, so this becomes 13,655. This remains at 2,000, and this becomes 11,655. Quick check, 13,655 minus 2,000, that's 11,655. Good. Then you have $1,100 out here, and you're going to have 800 here. Okay, quick check, 1,100 minus 300, 800. Good to go. Now, we've cleaned up all the numbers. Now, let's say they've given you these numbers for the parent and the subsidiary. Consolidate. Guys, we know that the parent, though they own the subsidiary, though they own 100% of the subsidiary, they still care. So that's a mnemonic, caring. So let's put it there. What's the common stock of the subsidiary? The common stock of the subsidiary, that's $100. So you're going to have $100 here. What's the APIC of the subsidiary? That's still $100. What's retained earnings of the subsidiary? That's 400 plus 200, $600 now. What's the excess fair value over book value? Now, it was $100, but during the year, that excess was depreciated, $20. So what remains is $80 here. Then you're going to have investment account, that was at 1,055, needs to be knocked off. Then you have goodwill, goodwill was $200, $25 impairment, 175. Quick check, does the debit equal the credit? 100, 200, 800, 880, 1,055. You're good. Let's build it up on a chart here. So C plus A plus R, the CAR of carrying, that's $800. The excess is $80. So CAR plus E, this becomes 880. And then you got goodwill of $175. Investment calculates to 1,055. So we've built up this chart using the journal entry there. This is just a sanity check, helps you understand the way you're moving on with this. So now that we have an eliminating journal entry in place, let's put it right there. So on the carrying, we had 100, 100 and 600. Basically, guys, this one needs to get eliminated. So you got a debit for this, 100, 100 and 600. CAR, E then E, this one 500. The excess fair value is no longer 100, it's 80. Goodwill is 175. And you knock off this investment, 1,055. Now, look at the consolidated balance sheet. So it's my cash, 2,600. Your cash, 300. We love each other. We're together. 2,900. Our cash. My receivables 1,500. Yours 200. Ours 1,700. My inventory 500. You have 100. We got 600. I cannot have investment in you because you're a part of me. That's what the parent tells the sub when they're doing the consolidation. Knock this off. PP&E. My equipment, your equipment, our equipment. But my equipment is at book value. Your equipment, fair value. 8,580. Goodwill. I got this goodwill because I paid an excess for you. Now I paid $200 excess for you, of which $25 is impaired, $175 remains. This total becomes $13,955. Now looking at liabilities, my payables, your payables, we'll clear it off together, $850. My bonds, your bonds, we're bonding, $1,450. Gives you $2,300 of liabilities on the consolidated balance sheet. Then you have my common stock, your common stock, I own it, so it's just my common stock, $1,000. APIC, my APIC, your APIC, I own it, just my APIC. My retained earnings, your retained earnings, I own your equity, so just my retained earnings, $7,655. This gives you a total of $11,655. Sanity check, $13,955 minus $2,300 gives us $11,655. So these are the numbers that you're going to have on the consolidated financial statements which you're going to report out. So this is the worksheet that we prepared, the Excel spreadsheet, we could do that. Now we're going to take these numbers and have them on the financials that we're going to report out on the consolidated financials to the users. So let's go and put these numbers on the dashboard so that you understand that here we're doing the spreadsheet and there we have the financials that we're reporting out to all our users, all our investors, stakeholders. So now these numbers are going to be different. So let me just quickly put it. It's a repeat exercise and happens very quickly. 2,900, 1,700, 600, no investment in myself, 8580, 175 gives me a total of 13,955. Accounts payable on the consolidated financials, 850, bonds payable 1450, 2,300 of liabilities, common stock 1,000, only the parent, APIC only the parent, retained earnings only the parent. That gives us 11,655. This plus this, 13,955. Guys, we are all set. We are ready with the balance sheet. We're going to show it out on the consolidated financials. On page 9, we're looking at the second example on consolidation, where the parent acquires 100% in the subsidiary during the year and the consolidation that happens at year end. Highlight acquisition date was 11x2 and a couple of lines below that highlight consolidation as of 31st December x2. So during the year, the parent used the equity method. So for the 4 journal entries that you have there, put a bracket and write equity method during the year. At the end of the year, for consolidation, we need to prepare the eliminating journal entry. So draw a bracket around that and write eliminating journal entry equals carrying. And now we are all set to prepare the consolidation worksheet. Put a box around worksheet, where you have the pre-consolidation numbers and then you make adjustments for the eliminating journal entry. Draw an arrow from where you've written eliminating journal entry down to the consolidation worksheet. And this helps you get to highlight consolidated financial statements. We've seen a couple of examples where we had the parent owning 100% of the subsidiary. Now let's say the parent acquires more than 50% but less than 100% of the subsidiary, say 90%. Does the parent still control? Yes, they do. That's more than 50%. But the parent does not own all the stock. There are some other holders, other equity holders who do not control, non-controlling interest holders who own the remaining 10% of the subsidiary stock. Now, if we look at the parent and the sub as one entity, there are 2 owners of the consolidated entity. Number 1, the equity holders of the parent who've got the lion's share. And number 2, you have non-controlling interest holders who own a small percentage, in this case 10% of the subsidiary, as owners of the consolidated entity. So since the non-controlling interest holders are also owners of this consolidated entity, we're going to put their ownership under the equity section of the consolidated balance sheet. So guys, once again, though the parent owns only 90% of the stock of the subsidiary, we're going to include 100% of the subsidiary's assets out here. We're going to include 100% of the subsidiary's liabilities out here. And that is why for the remaining 10% which the parent does not own, we're going to have a number for non-controlling interest out here. Now, under the full goodwill method that we use under GAAP, the value of this non-controlling interest is number of shares held by the non-controlling interest holders into the fair market value of each share. And this also would perfectly fit in our mnemonic carrying, where N stands for non-controlling interest. So I'm going to look at an example on the book, and before that, let me clear the board up. Let me clear our template so that we can just fit in the numbers and understand what's happening here. So this was our reporting consolidated balance sheet, our mnemonic carrying. So guys, if you look at it, step number 1, we're looking at carrying. Step number 2, we're building this chart just to make sure we're good with the journal entry. And step number 3, we have a consolidation worksheet, where we have the numbers for the parent and subsidiary as per their books. We got this eliminating journal entry, and we prepare consolidated balance sheet. Now, we got numbers here. So it says, using facts from the first example on consolidation, assume that P company or the parent acquired 90%, not 100%, 90% of the stock of S company in an acquisition on 31st December X1 for a payment of $810, not 900, 810. At this time, all of the assets and liabilities had fair values equal to the book values with the exception of equipment, with the remaining life of 5 years having fair value $100 higher than book value. At the date of acquisition, S company had 100 shares of stock outstanding, fair market value $8 per share. So guys, again, we are back to our first example that we saw in consolidation, where acquisition happens at year end, consolidation on the same date. So acquisition happening on 31st December X1, consolidation on the same date. But this time it's not 100% ownership, it's 90% ownership. Remaining 10%, remember, those are the non-controlling interest guys. So looking at the balance sheets of the parent company and the sub company before consolidation, let me just change the numbers and get the right numbers in place. Those numbers are going to be given to you on your CPA exams, so don't you worry about these. You got 190, that's the cash for the P company, and $100 is for the S company. Investment in S is now 810. Then you have, this becomes $11,000, and here we have 900. Liabilities remain the same, 1,000, 3,000, and 5,000 for retained earnings, and you have 100, 100, and 400 for retained earnings. So it's $9,000 for the parent equity and $600 for the sub. 11,000 minus 2,000, 9,000. 900 minus 300, 600. We're good to start, and we've cleaned up all the other numbers on the board. Good, looks pretty neat. Now let's start with looking at this example. So guys, step number 1, we're looking at our mnemonic carrying. So the parent tells the subsidiary, I own you, I control you, but I still care for you. So in this case, we got subsidiaries common stock $100, subsidiaries APEC $100, subsidiaries retained earnings, that's $400, excess book value $100. Excess fair value over book value $100. Then you got investment. Now this time the investment number is 810 there. you have non-controlling interest. Now I told you non-controlling interest is going to be number of shares which the non-controlling interest guys hold into fair value of each share. So non-controlling guys, they hold 10 shares. Fair value $8 per share. So they are owning shares worth $80. So how much is the residual goodwill? So this is 400, 600, 700, and this is 890. 890 minus 700 gives us 190. So if the non-controlling interest, this was $90, goodwill would have been 200. But this is $80 fair value as per the market price of the stock. So now building up on the chart that we have, book value is C plus A plus R, that's $600. Excess fair value $100. Then you have 600 plus 100, fair value is 700, and then you have goodwill. But let's calculate this first and then we'll do goodwill. So interest plus investment plus non-controlling interest. This number calculates to 810 plus 80, 890. 890 minus 700 gives us goodwill, which is $190. So we're good with the journal entry, eliminating journal entry, caring. We've built up a chart just to make sure our understanding is very clear on this, and then we're going to fit in the numbers on the worksheet. Remember, at year end we're going to prepare a worksheet, consolidation worksheet. So now if you look at the worksheet there, we're going to have debit to common stock of subsidiary, APEC of subsidiary, retained earnings of subsidiary. Then we're going to have excess fair value for the equipment of the subsidiary, $100, and we're going to have goodwill, $190. Now on the credit, we got investment, we're going to knock this off, and we are creating an account called non-controlling interest, which is as part of stockholders' equity. Now this number is $80. Now it's become simple and easy. So guys, my cash, your cash, let's put our cash 290. My receivables, your receivables, our receivables 1700. My inventory, your inventory 600. Investment knocked off. I can't have an investment in myself. PP&E 8,000 for the parent, 500 for the sub. But sub, that's at fair value. So 500 plus 100, 600 gets 8,600. Goodwill 190, residual on acquisition. So now this total is 11,380. You got accounts payable, my payables, your payables, our payables. We're bonding together, 1450. Gives us 2,300 for liabilities. Looking at equity, my common stock, not yours, because I own your common stock, $1,000. My APEC, not yours. But I don't own all of you. I own only 90% of the subsidiary. 10% of the subsidiary is owned by these non-controlling interest holders. So they've got $80 in here. And you got retained earnings. That's only my retained earnings, $5,000. Calculates to $9,080. Quick check. 11,380 minus 2,300 gives us 9,080. So balance sheet tallies. So guys, if you look at it, it's pretty much simple. Just that on caring, we also had the N, non-controlling interest here. So once you have that in place, everything is set. So we've done our journal entry, we've checked it with this chart, we've created this worksheet, we have the final numbers here. Now we can go out and report it out to the users. So let's do that quickly. I'm just putting in the numbers here to explain that we're doing the worksheet calculations there, and finally we are ready with this financials, this balance sheet that we give it out to our users. So let me quickly put in the numbers here. Cash 290, accounts receivable 1700, inventory 600, equipment 8,600, goodwill 190 now, so that's 11,380. Accounts payable 850, bonds payable 1450, total 2,300. Common stock 1,000, APEC 3,000, non-controlling interest 80, and retained earnings 5,000, 9,080. So that's the balance sheet, consolidated balance sheet. And we have non-controlling interest holders who own 10% of the subsidiary, which is a part of the consolidated balance sheet. Is one thing that you really want to understand here. Let's go back there. The parent owned 90% of the subsidiary. So ideally you would have expected $190 of this cash, that's the parent's cash. And the parent has only 90% of the subsidiary cash. So it should have been 190 plus 90, 280. But no, we do it 190 plus 100. We take 100% of the subsidiary. So guys, though the parent owns 90% of the subsidiary, they're taking 100% of the net assets of the subsidiary. And that is the reason you need to have this non-controlling interest to make sure that the numbers tie in. So parent owns 90% of the subsidiary, but we're looking at the consolidated entity, which has got two owners. Number one, the equity holders of the parent, and number two, the non-controlling interest holders, which own a small portion of the subsidiary. Now, valuation of non-controlling interest holders. Now, in this example, you had the numbers given to you. You had the fair market value of $8 per stock given to you. Now, let us say the fair market value of the stock was not given, or we didn't know that. In that case, under the full goodwill method, so for GAAP, you got to use the full goodwill method. You would say, so we don't have this number, $80. Then you would say that the parent paid $810 for 90% stake. So if 90% is 810, what's 100%? What's the valuation? 810 divided by 90% gives you $900 valuation. And what's the non-controlling interest? That's 10% of this. So 10% equals 10% into 900 gives you $90. So in that case, you would have had non-controlling interest as $90 and goodwill would have calculated to $200. So under the full goodwill method, first you look at whether you have the fair value of the stock. So in this case, we had the fair value, $8 per stock. So we'll use that. If you didn't have the fair value, then you allocate all the goodwill as per this method. You create a valuation for the company and look at what's the percentage of the non-controlling interest holders. Anyways, residual would always be goodwill. So in this case, if you had built up, it would have been 600 plus 100, 700. Investment 810, non-controlling 90. So 810 plus 90 would have been 900. Goodwill instead of 190 would have been $200. So this is the full goodwill method required for GAAP. Now IFRS is okay with this full goodwill method, but they prefer a partial goodwill method. So under the partial goodwill method, what we do is we're going to allocate only this to the non-controlling interest, guys, not the goodwill. So that's why partial goodwill, not both of this, just this. So we have the fair value of the net assets of the company, and we're going to allocate 10% of this to the non-controlling interest, guys. We will not allocate them any portion of the goodwill in excess of fair value. So fair value is 700. So if we had used partial goodwill method, which is a preferred method under IFRS, not allowed under GAAP, non-controlling interest would have been 10% of $700 or $70. So non-controlling interest in that case would have been, let me use a red pen, $70. So 880 minus 700, goodwill would have been 180. So guys, I'm talking about two methods here, full goodwill method, partial goodwill method. Full goodwill method is required under GAAP, okay for IFRS. Partial goodwill method, not under GAAP, only an IFRS method. But let's stick to the valuation of the shares that's given to us, and let me clean all this. Getting back to what we have on the book, we had 100 shares of stock outstanding, fair value of $8 per share. Non-controlling guys, they own 10% of that. So they own $80, and our goodwill here is 190. So guys, we are back to where we were. 3 steps here. Number 1, journal entry. Number 2, create this chart, be comfortable with the journal entry. Number 3, put the eliminating journal entry and create consolidated financial statements, and we're creating the consolidated balance sheet out here. Turn back to page 5 and let's look at the N of our carrying non-controlling interest. Highlight full goodwill method, US GAAP and allowed for IFRS. Now in this case, highlight non-controlling interest equals active market price of the subs shares on acquisition date into the number of non-controlling interest shares. And then highlight if active market of the subs share is not available, calculate the value of the non-controlling interest based on the purchase price of the parent. Now the next method, highlight partial goodwill method, which is not allowed under US GAAP but preferred for IFRS. Under this method, highlight NCI or non-controlling interest equals the fair value of the subsidiary's net identifiable assets multiplied by the non-controlling interest percentage. On page 12, we're looking at a third example on consolidation, where the parent acquires 90% of the subsidiary at year end. So circle 90%. Highlight acquisition on 31st December X1 and also highlight consolidation as of 31st December X1. Now in this case, we have the parent acquiring 90%. So there is a non-controlling interest for 10%. So right, NCI under full goodwill method, that equals $8 fair market value into 10 NCI shares, and that calculates to right equals $80. So the number for non-controlling interest on the journal entry carrying would be $80. So with that, we are looking at a eliminating journal entry. So draw a bracket and write eliminating journal entry equals carrying, CAREING. After doing the eliminating journal entry, put in the numbers on the chart just to make sure everything looks right, and then we are set to prepare the consolidation worksheet. Put a box around worksheet. So we have the pre-consolidation numbers on the parent's books and the subsidiaries books, and then we have adjustment for the eliminating journal entry. So draw an arrow from where you've written eliminating journal entry to the 2 columns on the consolidation worksheet. So after this adjustment, we are ready with our highlight consolidated balance sheet. So we've looked at 3 examples on consolidations till now. In the first example, we had the parent acquiring 100% of the subsidiary, 100% on year end. Consolidation was on year end, same date. In the second example, the parent again acquired 100% but at the beginning of the year, and the consolidation happened at the end of the year. In the third example, that's where we got non-controlling interest in. So the parent did not acquire 100%, they acquired 90% of the subsidiary at year end, consolidation at year end. Now naturally, the fourth example, we'll continue to have the non-controlling interest, and now we'll look at the parent acquiring 90% at the beginning of the year and the consolidation happening at the end of the year. Now guys, before we move on and look at this example, I want you to compare consolidations when we have less than 100% stake with the equity method. So in the equity method, where you could have, let's say, 30% or 40% ownership, we used to multiply everything by the percentage ownership. In case of consolidation, we are taking 100% because on the balance sheet, we have 100% of the subsidiary's assets, 100% of the subsidiary's liabilities, and a number for non-controlling interest. Under the equity method, it was only a simple one-line consolidation where the consolidation happened into investment account, and we were really concerned about the percentage ownership. That was 20 to 50% ownership. FAR-3, if you don't remember. Now we're looking at consolidation. The moment you have control, you own more than 50%, you have all of the subsidiaries assets, all the liabilities onto your balance sheet. Even on the income statement, we'll talk about that. You're going to have all of the subsidiaries revenues and expenses after acquisition on the consolidated income statement. So now let's look at the example that we have, and this is the fourth example where the parent acquires 90% of the subsidiary at the beginning of the year and the consolidation happens at the year end. So instead of 31st December X1, we again have 1/1/X2 as the date of acquisition. So looking at the example here, using facts from the first example on consolidation as well as the previous example, assume that the acquisition date was 1/1/X2. Equipment with the excess fair value had a 5-year life. Goodwill on acquisition impaired by $25 as of 31st December X2. Income during the year for P was $2,500, S was $200. Investment accounted for under the equity method. So during the year, parent used equity method. Also assume that S paid dividends of $10 during the year. So guys, this is as complicated as it can get. So let me first do the cleanup. Let me get the numbers off the board so that we can use the same template. So the first thing that we're using is caring. So the parent tells the subsidiary, I care for you. And then you have this chart that we generally prepare, which is like an extension of this journal entry, but helps you be sure that everything is right. Gives you a feeling that all is well. Rubbing these numbers. Oh, I forgot my example there. Let me get it. Okay, let me also rub the dashboard. So, you see me rubbing it? You like? Yeah? Yeah. That's the quick cleanup that I've done. And now I'm looking at the example. So, my dashboard's clean. My journal entry is clean. My worksheet is more or less clean. Let's get back to the worksheet. So now, 90% was acquired at the beginning of the year for $810. So this remains at $810. And then during the year, you had the parent earning $2,500, the subsidiary earning $200. So we could do 2,500. Let's say all the earnings were in cash. And even here, all the earnings were in cash. Makes it simple, easy. And then you had, let's say, the subsidiary's earnings. So subsidiary earned $200. Now, the parent owns 90% of the sub. So under the equity method, they're going to take only 90%. When we consolidate later, it will be 100%. But as I told you, under the equity method, we'll take only 90% of that. So on this investment account maintained under the equity method, you're going to have plus 180 here. Guys, understand? Under the equity method, you take only the percentage of everything. It's only when we do consolidation that we're going to take 100% of the sub. Even in the retained earnings, you're going to have 180. Okay. And then you have a couple of adjustments where there's a depreciation of the equipment and impairment of goodwill. Now, even though you have non-controlling interest for 10%, for depreciation of the equipment and impairment of goodwill, everything is taken by the parent, 100%. So you got depreciation $20, impairment $25. So this calculates to $135. So retained earnings, I'll just put it as $135. Now after that, you're going to have, okay, the tricky thing here, S paid dividends of $10 during the year. So subsidiary paid dividends. So they had minus 10 and naturally their retained earnings reduces by 10. No. Yeah, on this it'll be a plus 10 actually because it's a negative number. For the parent, they own 90% of the subsidiary. So when the subsidiary declares dividends of 10, they receive 9. Investment goes down by 9. What else? Okay, I think we're set. So now you won't have all this on your exams. I'm just trying to show you how I'm building up on the examples that we've had. So let me show you what you'll have on your exams. So you'll have 2699 here. And the cash of the subsidiary, that's going to be 300 minus 10, 290. Next, you're going to have 810 plus 135. That's 945 minus 9. So this is minus 9. Sorry, minus 9 gives you 936. So looking at the retained earnings numbers, super complicated. Gives you 7635 here. Totals would change and gives you $590 here. Looking at the totals, this is 13,635. This is 1,090, and then you have 11,635 and 790. So 13,635 minus 2,000 gives you 11,635. Good. 1,090 minus 300 gives you 790. So this is all good. Now let's get to the carrying journal entry. Now guys, once again back here. So you got the parents' financials and the subsidiaries' financials. So assume you're given these numbers on your CPA exams. Now you got to prepare the carrying journal entry. So that's what we're doing here. So you got to get the subsidiaries equity of the common stock is $100, APIC is 100, retained earnings is 590. Now excess fair value over book value, $100 less $20 of depreciation gives you $80. The investment number, that's 936. Okay, non-controlling interest. So non-controlling interest was $80 at the time of acquisition. So if I draw the NCI account here, there were $80 when the acquisition happened. That's a credit account. That's part of equity here. That's always a credit account. So non-controlling interest, when we started the year, it was $80 because the fair market value of those shares, 10 shares that were held by non-controlling interest was $8 a share. Now, during the year, the company, the subsidiary earned $200. 10% of that goes to non-controlling interest. So they got $20 out of that. So that's 10% of 200 earnings. And the subsidiary paid out dividends of $10. Non-controlling interest, they got 10% of $10. So they got $1. So if you look at it, you got non-controlling interest, credit was 80 plus 20, 100. Debit was 1. What's the net at year end? 99. So 80 was what we started with. So this was the fair market value at acquisition. During the year, as the subsidiary earned, non-controlling interest went up. Subsidiary paid out dividends, went down. So we're following similar to the equity method for non-controlling interest, guys. Now they are at 99. So 99 is the number that you want to have here. Now your goodwill, it was 190 at the beginning of the year. $25 impairment ends up being 165. Now you want to check whether the debits and the credits are the same. So the debit and the credit. So this side you have 936 plus 99. That gives you 1,035. Here you have 790, 790, 870, 870, 935, 1,035. So your debits equal to your credits. And to be more sure, let's build this up. Book value, 790. Excess, 80. 790 plus 80 gives us 870. Plus the good, okay, brother, let's look at investment plus non-controlling. So 936 plus 99 gives us 1,035. 1,035 minus 870 gives us 165 of goodwill. Ties into our calculations, we're good to go. So guys, you got carrying here, you got CAR here. You've added E. This becomes CAR plus E. Then you're looking at investment plus non-controlling interest here, and CARE. The difference between CARE and investment and non-controlling interest, that's your residual goodwill. So this is the goodwill. So the direction you move is from book value, you go to fair value. From fair value, you go to purchase price, or rather the sum of investment and non-controlling interest. And from there you calculate the residual, which is goodwill. You can go in any direction, just make sure the numbers fit in, they tie in well. So now we got the numbers here. Let's put this eliminating journal entry onto our worksheet. So you got the equity of subsidiary going off, so that's debit 100, 100 and 590. So that's CAR. E was for the equipment that the subsidiary held, E, and then you had goodwill was 165. So this was all the debit. On the credit you had investment 936. For non-controlling interest you had $99. So that's 1,035 of debit and 1,035 of credit. Now looking at the consolidated balance sheet, so it's my cash, your cash, our cash 2989. My receivables, your receivables, our receivables 1700. Our inventory of 600. Investment knocked off. Equipment you have 8,000, my book value plus 500, your book value plus 80, excess fair value over book value 8580. Goodwill 165. Total assets 14,034. Our payables 850, our bonds 1450, total liabilities 2,300. My common stock 1,000, my APIC 3,000, then you have non-controlling interest 99 and my retained earnings 7,635. So that gives a total equity of 11,734. So 14,034 minus 2,300, that gives us 11,734. So all good with the numbers here. So guys, it's simple and easy. I mean, no matter how complicated they try to do it, if you use your mnemonic caring, it gets so simple, so easy. You just need to eliminate the subsidiary's equity. Look at the excess fair value over book value. Look at the investment number, non-controlling interest number, residual, goodwill. Build up this chart to be more sure. Plug in the numbers on the consolidation worksheet. Get your consolidated financial statement numbers. And now if you want, I'll take these numbers and I'll put it on the dashboard so that you have a revision when I write the numbers down there. So consolidated cash, that's 2989. Consolidation receivables 1700. Consolidated inventory 600. Investment you got nothing. 8580 of equipment, 165 of goodwill, 14,034. Payables 850, bonds 1450, 2,300 here, common stock 1,000, APIC 3,000, non-controlling 99, 7,635 of retained earnings 11,734. We're good to go with this. So guys, as you can understand, we've done it in 3 steps. Number 1, caring. Number 2, build up the chart. Number 3, the consolidation worksheet. Now that we're done with all the 4 examples, let me do a quick recap on non-controlling interest. So guys, all of you in class know that non-controlling interest, that's created when the parent owns less than 100% of subsidiary. So the parent controls but doesn't own 100%. So they own more than 50% but not 100%. Like in our example, the parent owns 90% of the sub. When you're computing non-controlling interest under GAAP, you use the full goodwill method. So your first preference is you want to use the fair market value of the stock into the number of non-controlling interest shares. So you're going to use the fair market value of the stock on the acquisition date because that's the date you want the non-controlling interest number. Then if that is not available, then you look at the valuation which the parent assigned to the subsidiary based on this investment number, initial investment. And based on that valuation, you calculate the value for the percentage of non-controlling interest. So if it's 10%, 10% of that value which the parent assigned to the subsidiary. Now the parent didn't acquire 100%, they acquired less than 100%. Okay, now talking about the financial presentation of non-controlling interest. So on the balance sheet, we saw that though the parent owned less than 100% of the subsidiary, the assets were including 100% of the subsidiary's assets. Liabilities, you had the parent's liabilities plus 100% of the subsidiary's liabilities. And that is why, along with the parent's equity, you also had the non-controlling interest number. Now, on the income statement, after acquisition, you're going to have the parent's income plus the subsidiary's income. And you're going to have 100% of the subsidiary's income after acquisition. And then when you have this net income number, all this net income is not for the parent. Some of this is also for the non-controlling interest holders. So on the income statement, you're supposed to disclose what portion of net income is for the parent shareholders and what portion is for the non-controlling interest holders. So you're going to disclose portion attributable to parent shareholders and portion attributable to non-controlling interest holders. And then you have on-tied N, and then if you have your comprehensive income statement, you're going to have OC. Again, for comprehensive income, you're going to say what portion is attributable to the parent stockholders and what portion is attributable to non-controlling interest holders. And then you're also going to have the statement of changes in stockholders' equity, and there you'll also talk about how non-controlling interest has changed from the beginning of the year to the end of the year. Now, we had a ledger account, T account that we created here. So we looked at how non-controlling interest changed from $80 at the beginning of the year to $99 at the end of the year. This is something you'll have on your statement of changes in stockholders' equity. And then when you're looking at retained earnings on the consolidated balance sheet, this becomes a consolidated income statement here. So when you're looking at retained earnings on your consolidated balance sheet, you're going to have beginning retained earnings. So beginning retained earnings, that's the parent's retained earnings, acquirers. Then you'll have plus net income for the year. Net income, you'll have the parent's net income plus the subsidiary's net income, both. The subsidiary's net income that you're looking at, you would be looking at the portion which is attributable to the parent stockholders, because the portion which is attributable to non-controlling interest flows into NCI, not retained earnings. And then you have less dividends. So you're looking at dividends paid by the parent only, because the subsidiary's dividends, they come into the parent. They are adjusted on the investment account, which is knocked off at year end. And that's how you calculate your ending retained earnings. So guys, I know there's a lot of content that you have here, but just get comfortable with the basics. The basics here is your mnemonic, caring. On page 13, we are looking at a fourth example on consolidation, where the parent acquires 90% of the subsidiary during the year and the consolidation happens at year end. So circle 90%, highlight acquisition on 1/1/X2, and highlight consolidation on 31st December X2. Now, during the year, the parent decides to use the equity method for the investment in subsidiary. So, in the parent's books, you're going to put a bracket around those 5 journal entries and write equity method during the year. At the end of the year, before consolidation, we need to prepare the eliminating journal entry. So draw a bracket and write eliminating journal entry equals caring, CAREING. And with this, we are set to prepare the consolidation worksheet. Put a box around worksheet. So we have the pre-consolidation numbers for the parent and the subsidiary. And then we would make adjustments for the eliminating journal entry. Draw an arrow there. And this gets us to consolidated balance sheet. Highlight consolidated. Turn on to page 14, and here I want to show you how non-controlling interest account works. So draw a T account for NCI, and we'll start with the credit number for $80, which was fair value at acquisition. So fair value per share was $8 into 10 non-controlling interest holder shares. That gives us $80 fair value for non-controlling interest at acquisition. And then we want to increase NCI to the extent of earnings attributable to the non-controlling interest holders, which is right $20 because that's right 10% of $200 S earnings. So you started with the beginning number, increased it by earnings, need to reduce it by dividends. So on the debit, write 1, which is 10% of $10 S dividend. So $80 plus $20 earnings minus $1 dividends, which goes into NCI. This calculates to write $99 ending non-controlling interest. Now turn back a couple of pages and get to page 10, where we're looking at non-controlling interest, which is created when the parent acquires more than 50% but underline less than 100% stake. Highlight computation of NCI, and we know highlight on acquisition date use the full goodwill method. And then highlight after the acquisition date NCI is accounted for using the equity method. Highlight beginning NCI, and to that you add highlight NCI's share of the subsidiary net income. Highlight subtract NCI's share of the subsidiary's dividends, and that gives you highlight ending NCI. Now we just looked at the T account for the non-controlling interest, and I want you to put the numbers again here. So write $80 for beginning NCI plus $20, which was the NCI share in the subsidiary's net income of $200, minus $1, which was the NCI share in the subsidiary's dividends of $10, gave us right ending NCI of $99. Moving down on this page, put a box around financial statement presentation. Highlight consolidated balance sheet, and highlight includes 100% of the subsidiary's assets and liabilities. Note that the subsidiary's equity or CAR in carrying is eliminated. Next one, highlight NCI must be reported at fair value in the equity section of the consolidated balance sheet separately from the parent's equity. Next, highlight consolidated income statement, and highlight includes 100% of the subsidiary's revenues and expenses after the date of acquisition. And highlight portion of net income attributed to the parent and to the NCI must be disclosed. And underline net income attributable to NCI equals subsidiary's net income multiplied by the NCI percentage. Move to page 11, highlight consolidated statement of comprehensive income. And on this statement, highlight portion of the comprehensive income attributed to the parent and to the NCI must be disclosed. And underline comprehensive income attributable to NCI equals the subsidiary's comprehensive income multiplied by the NCI percentage. On the next bullet, we're looking at highlight consolidated statement of changes in stockholders' equity. And on this statement, we are also going to highlight present a reconciliation at the beginning and ending of the period of the carrying amount of, on the next line, highlight equity attributable to the NCI. So on this statement, we're going to have a reconciliation of the total equity, of the equity attributable to the parent and also of NCI. And then when we're looking at highlight statement of retained earnings, on the consolidated balance sheet, you're going to have highlight beginning retained earnings, and that's going to be highlight parent only. Then you have highlight plus net income, which is highlight parent's net income for the whole year, plus highlight subsidiary's net income from the date of acquisition attributable to the parent's shareholders. And note here, The acquiree's income or the subsidiary's income, which is attributable to non-controlling interest holders, that goes into NCI, does not come into retained earnings. And then we have minus dividends, which is highlight parent only. And we'll talk about subsidiaries dividends, which come into the parent, they get eliminated during consolidation. And this gets you to highlight ending retained earnings. We've had a pretty cool run here. We've looked at 4 examples back to back, and now we know all about consolidation. So guys, we got the parent's financials and the subsidiary's financials. The parent, they control the subsidiary. In essence, it's one economic entity, and that is why we prepare consolidated financials for reporting purposes. So this balance sheet that you have becomes a consolidated balance sheet. The income statement that you prepare becomes consolidated income statement. So guys, when we're looking at, let's say, the asset side of the balance sheet, we're looking at the parent's asset plus the subsidiary's assets. So it's my assets and your assets, it's our assets, because we are one economic entity. We're preparing consolidated financial statements. When you're looking at liabilities, you got the parent's liabilities plus the subsidiary's liabilities. My liabilities plus your liabilities, it's our liabilities now. But when we're looking at the equity section, we only have the parent's equity out here, not the subsidiary's equity. Understand the logic here. So you got parents, stockholders. Who own the parent. And then you have the parent which owns the subsidiary. Now when you're looking at one economic entity where we are seeing the parent and sub, they are in a sense just one entity preparing consolidated financials. Who is the owner of this one economic entity? The parent's stockholders, because the subsidiary stock, that's owned by the parent. You can't own a stock in yourself. So the owner of this consolidated entity is the parent's stockholders. That's why the subsidiary's equity, that's eliminated. Now, then we had the complication of non-controlling interest holders, where we had the parent not owning 100%. Let's say the parent owns 90%. That is where you had non-controlling interest. Which owned, let's say, 10% of the subsidiary. Now when we are looking at it as an economic entity, once again, who's the owner of this economic entity? The parent stockholders, they own the parent. And through the parent, they own a majority stake in the subsidiary. But a minority stake in the subsidiary is owned by other guys, the non-controlling interest holders. So if this is one economic entity, you got 2 sets of owners here. One set, the lion's share, parent stockholders. Small share, non-controlling interest holders. And that is why we had non-controlling interest as part of stockholders' equity on the consolidated balance sheet. So it was the parent's equity plus non-controlling interest holders, which we had presented before the retained earnings number. So assets, parents plus subsidiary, are assets, are liabilities. Equity only parent. If the parent does not own 100%, it controls, owns more than 50%, but less than 100, that is when you have non-controlling interest on the consolidated balance sheet. Now, looking at the consolidated income statement, again, you'll have the parent's income, so you'll have the parent's revenues, parent's expenses, gains and losses, plus the subsidiaries' revenues, expenses, gains and losses. So it's going to be my revenues and your revenues, it's our revenues. My expenses, your expenses, our expenses. My gains and losses, your gains and losses, that's our gain and losses. So that becomes consolidated income statement. Subsidiaries numbers, you start including from the date of acquisition. So after the parent acquires the sub, that's when you start including the subsidiaries numbers on the consolidated income statement. So here you calculated this net income number. Now this net income, you could allocate this to both these sets of owners. Naturally, a lion's share would go to the parent's stockholders. A small share would also go to non-controlling interest. Let me use a red pen for this. What we're saying is the net income on the consolidated income statement, that's the parent's net income plus the subsidiary's net income, our net income. This would flow into retained earnings. But onto retained earnings, we'll have the parent's portion plus, let's say, 90% of subsidiary. If the parent owns 90% in the subsidiary. Who owns the remaining 10% in the subsidiary? Non-controlling interest holders. So 10% of sub, that would flow into non-controlling interest holders account. So guys, we are having a big portion of this net income which is attributable to the parent's stockholders. A small portion attributable to the non-controlling interest holders. So the portion of the income which is attributable to non-controlling interest holders does not go into retained earnings of the parent stockholders. It goes into the non-controlling interest holders account. So guys, when we're looking at retained earnings of the parent, we have beginning retained earnings of the parent plus net income for the year. Net income for the year, we're looking at the portion which is attributable to the parent stockholders, which is all of the parent's income plus a big percentage, a major percentage of the subsidiary's income. A small percentage of the subsidiary's income does not flow into retained earnings, goes into non-controlling interest. Now let's talk about dividends. So when the parent is declaring dividends, paying out dividends, it pays out dividends to its stockholders. How about the subsidiary declaring, paying out dividends? They pay out dividends to the parent because the parent owns majority of its stock, even 100%. If the parent does not own 100%, that's when you have non-controlling interest holders who also get their share of dividends from the subsidiary. Now, if you look at this dividend, this flows to parents' stockholders, and that's what we reduce from retained earnings. So you got beginning retained earnings plus net income for the year attributable to the parent stockholders minus dividends paid out to parents' stockholders. So that gives you ending retained earnings here. We're good to go with this. How about the dividends which the subsidiary has paid out to the parent? Can you pay out dividends to yourself? No, you can't. So this one needs to be eliminated when you're consolidating the financials. And it actually gets eliminated automatically. Think about it. When the subsidiary is paying out dividends to the parent, that affects the subsidiary's retained earnings. Now, subsidiary's retained earnings, we've eliminated that. We only have the parent's retained earnings here. And that affects the investment in subsidiary account that the parent has. Even that was something we eliminated. Can't have an investment in yourself. So guys, once again, think about when you have this intercompany dividends. For the subsidiary, this was retained earnings debit and cash credit. So it was retained earnings to dividends payable. And then you had dividends payable to cash. For the parent, this was, let's say, dividend receivable. And the credit was to investment in sub. So if the parent used the equity method of accounting for the subsidiary's investment during the year, as the subsidiary earned, the investment in sub account went up. When the subsidiary paid out dividends, that account went down. So credit here. And when they actually got in cash, so it was cash to dividend receivable. So if you look at this, dividends payable, that gets eliminated. Let's say all the dividends declared were paid out. Receivable, that has all come in. That's good. Now, cash has moved out from the sub and flown into the parent. That doesn't make a difference because we would anyways have added the cash. My cash, your cash, just the same, our cash. Now, what this has actually impacted is retained earnings of the subsidiary. Do we have the retained earnings of the sub here? Remember the R of caring, we had eliminated this. So we had CARING, the R of caring, we eliminated the retained earnings of the sub. How about investment in sub on the parent's books? That was the I of caring, that too got eliminated. So CARING, and this was the I of caring. So guys, as you understand, the dividends paid by the subsidiary to the parent is automatically eliminated the moment you prepare a consolidated balance sheet. The moment you remember the favorite mnemonic caring, where the parent tells the sub, I still care for you. Now, you would have numbers on the consolidated balance sheet if dividends have been declared but not yet paid out. So let's say dividends have been declared by the sub, not yet paid out. Then on the consolidated balance sheet, you would have a number for dividends payable, which would be there on the liability side. And on the asset side, you would have the number for dividend receivable, because you're doing our assets and our liabilities. That is when you would have to prepare an eliminating journal entry for this, because I cannot have a dividend payable to myself. I cannot have a dividend receivable from myself. So only if dividend have been declared but not yet paid out. So we are looking at the eliminating journal entry. So we would anyways do caring, where retained earnings and investment in subsidiary, they are knocked off. And if we have this dividends declared but not yet paid. Now, on the liability side, we got dividend payable by the sub. Can't have a dividend payable to yourself, so we need to debit that liability. We'll have dividend payable debit. On the asset side, we'll have dividend receivable by the parent. Can't have a receivable from yourself, so we'll credit the dividend receivable. So guys, this eliminating journal entry is only if the dividend is declared but not yet paid. So this is declared dividend by the S and this is paid by S. Once it's paid, dividend payable and receivable are knocked off on their own and cash flows in from sub to parent, no issues. Now, talking about dividends once again. So when we're looking at retained earnings here, I said we're looking at beginning retained earnings of the parent plus net income, which is attributable to the parent, most of this, minus dividends which are paid out to the parent stockholders, gives us ending retained earnings here. Now, if the parent does not own 100% in the subsidiary, that's when you have non-controlling interest holders, a separate account on the equity section. So this account is beginning non-controlling interest plus income, which is attributable to the non-controlling interest. So you had parent plus subs income here. So let's say 10% of the subsidiary's income is flowing into the non-controlling interest account, because that one is not going to retain earnings. We have 90% going to retain earnings, 10% going to sub, the moment you have a non-controlling interest for 10%. So non-controlling interest account, beginning non-controlling interest plus earnings during the year, portion which is attributable to non-controlling interest, minus dividends paid out to non-controlling interest. So what we eliminate is the dividend which the sub paid to the parent. The dividend which the sub paid to the non-controlling interest, guys, that gets reduced from non-controlling interest here. Important concept, very interesting. You need to get this. Let's look at it again on the book, and then we'll come back and we'll look at a host of other intercompany transactions that we need to eliminate. So we'll talk about intercompany sale of inventory. So let's say the parent sells goods to subsidiary or the subsidiary sells goods to parents. What happens then? Let's say the parent and subsidiary sell PP&E to each other, Or let's say one of them has issued out bonds, the other goes to the market, repurchases those bonds. So we'll look at a host of intercompany transactions, and guys, hold on to your seats. We have a lot of interesting stuff to come here. Starting page 15, we are talking about intercompany transactions. Highlight, since an entity cannot engage in business transactions with itself, adjustments will have to be made on the consolidating worksheet in order to eliminate the effects of intercompany transaction. So you have the parent's numbers and the subsidiaries numbers, but now we are looking at one economic entity. Turn a couple of pages and get to page 19, where we're looking at highlight intercompany dividends. Now, dividends paid by a subsidiary to the parent must be completely eliminated during consolidation, as an entity cannot pay dividends to itself. Now, generally, there is no adjustment needed for dividends paid by the subsidiary to the parent, because highlight, dividends paid by the subsidiary to the parent impacts retained earnings on the equity account of the subsidiary and the investment account of the parent. Therefore, there is no effect of these intercompany dividends on the consolidated balance sheet, since both these accounts anyways need to be eliminated at the time of consolidation. Now, the only exception is, highlight, if the declared dividends are not yet paid by the subsidiary, then the intercompany dividend payable and receivable need to be eliminated. And that's done by passing the following eliminating journal entry, highlight dividend payable debit and dividend receivable credit. Note that, highlight, you do not need to eliminate dividends paid by the parent. Therefore, the consolidated statement of retained earnings only reports the parent's dividends. That's the dividends paid out by the parent. We just looked at intercompany dividends, where we saw the subsidiary paying out dividends to the majority holder, the parent. Now, if you look at the parent and sub as one economic entity, can an entity pay dividends to itself? No, they can't. And that is why this dividend paid by the sub to the parent got eliminated when we prepared consolidated financial statements. So now this elimination was pretty much automatic if there were dividends declared and paid out, because cash moved out from the sub, came into the parent, stayed with the economic entity. You had retained earnings of the sub getting reduced because they declared dividend, so retained earnings getting reduced. Now, retained earnings of the sub, that was anyways eliminated when we did our carrying journal entry. Investment in sub by the parent, that got reduced by the dividends declared. Now, that number automatically got eliminated when we did carrying journal entry, the I of carrying. Now, the issue was if there were dividends declared during the year but not yet paid. Now, in that case, the sub, they would have a dividend payable, and the parent, they would have a dividend receivable. And when we prepared the consolidated financials for this economic entity, I cannot have a dividend payable or receivable to myself. So we needed to eliminate those two accounts. Now, we look at a lot of intercompany transactions, and we'll do it in 3 steps. Step number 1, we'll look at what are the journal entries that have actually been passed by the parent and the sub when they were 2 separate entities, because both of them have their own set of books. Then we'll look at it as one entity. What would have been the journal entries which would have been passed had they be one entity, one economic entity? So, economic entity journal entry. Now, in this case, the economic entity, they can't pay dividends to themselves, so there would have been no journal entry. And that is why we would need an eliminating journal entry, where this dividend payable, let's say dividends not yet paid out, so this dividend payable needs to be debited. This dividend receivable needs to be credited. So guys, this was intercompany dividends. Now we look at intercompany sale of inventory. So guys, think about it. Can one division of an entity sell goods to another division of the entity? No, we can sell goods only to outsiders, not within the company. So that's the same concept. If the parent and sub are one economic entity and they have made sales to each other during the year, we need to eliminate that when we are doing consolidation. Because here we are having the parent sales plus the subsidiary sales. All the sales that the parent has made to outsiders comes in here. All the sales that the subsidiary has made to outsiders, it's coming here. But what if they've made sales to each other? Can't have it, because here we are preparing consolidated financials where we are treating the parent and the sub as one entity. And one entity cannot sell goods to itself. Let's look at this. We're looking at intercompany sale of inventory. So let's say we got the sub and the parent. Sub purchases goods from its vendors. And what the subsidiary does is they sell these goods that they have purchased to the parent. And the parent sells it to outsiders, customers. Now, when this transaction is happening, for the parent, it's a purchase. For the sub, it's a sale. So far, so good, as long as the sub and the parent are two different entities. But at year end, when we are consolidating these two entities, we are saying they are one economic entity. And within the entity, you cannot have the sale, you cannot have this purchase, needs to be eliminated. So guys, let's look at an example on the book and we'll understand how do we prepare this eliminating journal entry at year end. So we've already looked at carrying, that was one of our eliminating journal entries for the balance sheet accounts. Now we are looking at other transactions which also require eliminating journal entries. This was intercompany dividends. Now we are looking at intercompany sale of inventory. So looking at the example on your book, it says for each of the following intercompany transactions, past journal entries in the books of the acquirer, the P company, parent, and the acquiree, the sub, and the eliminating worksheet journal entry. So they're asking us for parents journal entries, subsidiaries journal entries, and the eliminating journal entry. Between these two, we're going to prepare the economic entity journal entry because that's going to help us understand what we're trying to eliminate. So let's look at this. So yet S company sold $100 of goods to P company. That's what's happened. At 20% profit on the sale price in cash. Now during the year, P company sold 90% of these goods purchased from S company for $150 cash. Okay, so it says P company was not able to sell all the goods it's purchased from S. It sold only 90% of the goods. Now first we'll assume that P company sold all the goods it purchased for $150. Then we'll look at 90%. So first, let's look at the journal entries that we're going to have on the books of the P company and the S company. So the S company, they're making the sale here. And the sale is happening for cash. So it's cash to sales $100. And it's 20% profit on sales. So what's COGS to inventory for S? $80. Now when you're looking at the parent P company, they're getting an inventory. Now it was at cost of $80 to S, but when the parent, they're buying it from S, they're paying $100 for that. So it's inventory to cash $100. Now P company is selling off these goods to the customers, outsiders for $150. So now let's say they're selling it for cash, they're having cash to sales $150. And naturally they have the cost of goods sold to inventory going out. the problem says 90% of the goods purchased, so 90% of these goods that were purchased goes out. Let me first start with 100% of these goods go out. Let's say all the $100 which was purchased went out here. So $100 inventory that came in here went out here for the parent. Now these were the journal entries when we treated the parent and the sub as two different entities. Now if they were one economic entity, so let's look at the economic entity journal entry. If we treat the sub and the parent as one entity, they could only sell goods to outsiders, not within themselves. So the sale which the parent made to the customers, that is something we're going to account for. So that was this transaction. So we're going to have cash to sales, 150. And then we have cost of goods sold for these goods. We're going to have COGS to inventory. For the economic entity, now for the economic entity, do these goods cost $100 or $80? $80, because if they're one entity, SS cost, the cost, we're not going to have profit on intercompany inventory. So this cost which subsidiary had actually paid to the vendors, that's the cost of goods sold that's going to be expensed on the consolidated financials. So for the economic entity, COGS to inventory should have been 80. So these were the journal entries all passed. These should have been passed. Guys, we don't like this cash to sales because this is happening within the company. We don't like this inventory to cash because buying goods within the company. So now what we'll do is at the end of the year, we'll prepare an eliminating journal entry where we'll move from this, what has actually been done, to this, what should have been done. So that's your eliminating journal entry. So guys, if you look at this, cash came in the company $150. Here again you have $150. So this is good. Cash came into S $100. Flowed out of P. So that's okay. Flowed out within the company, within the economic entity, that's fine. Now, when I'm looking at, let's say, sales, so I'm good with the cash numbers, cash is all good. When I'm looking at sales, sales should have been $150. So this $150, that's cool. But we have another $100 of sales here, which S made to P cannot have that. So now that we have done S plus P on consolidation, we need to get this $100 double counted off. How do we get sales off? By debiting it. So we would create a debit account for sales $100. So this one gets eliminated. Now looking at inventory. Inventory has gone out $80. What's inventory gone out here? This is 80. So this looks good because this is actually gone out. For the parent, inventory came in 100, went out 100. Good. So it automatically reversed. Looking at COGS, cost of goods sold on the consolidated for the economic entity should have been $80. Cost of goods sold is $80 here. This is good. It's another $100 here. This needs to be eliminated. So we're trying to eliminate the sales, the double entry that we have here, and the COGS here. So COGS, if you want to eliminate this $100, you want to credit it. Guys, let's quickly do this on the income statement here. So you got the parent and the sub. Yeah. So what we are saying is the sub is making a sale of $100 to the parent, and the cost of those goods is $80 for the sub. Now the parent has purchased these goods with $100 from the sub, so its cost of goods sold is 100 and it's selling it to outsiders for 150. Now when we are preparing consolidated financials, we would have, so I need a little more space here. So S is $100 and 80. So if I do a plus and plus for this, on the consolidated numbers, we'll have sales of 250 and cost of goods sold as 180. Now this is not right, as this sale and purchase was within the company. So instead of having 250 as sales, we just want to have this 150 as sales, which was made to outsiders. So this 250 needs to be converted to 150. Looking at COGS, you had 100 plus 80, 180 of COGS. No, this is only 80, which was purchased from outsiders. So this needs to be converted to 80. We need to reduce sales by 100, COGS by 100 when we are preparing the consolidated financials. And this adjustment is done on the worksheet. So on the worksheet, sales needs to go down by $100 from 250 to 150. COGS needs to go down by $100 from 180 to 80. And that's what we've done here on our eliminating journal entry. We have eliminated the intercompany sale of inventory, the sale of inventory from S to P. We know that S purchased it from the vendors at $80. P sold it to its customers for $150. We are happy this 150 as sales and 80 as COGS. What we are not happy is with this $100 intercompany transaction, and that is what we have eliminated here. Now, the complication that you have on this problem is that P did not sell all the goods that it purchased from S. It sold only 90% of those goods for the $150. So it purchased goods which costed S $80 for $100, and it could sell only 90% of the goods. 10% of the goods which it purchased from S was remaining in the ending inventory of P. Now guys, think about it. S purchased the goods for $80, sold it to P at a profit. Now that P has some ending inventory, there's a profit in ending inventory. And when this is one economic entity, can you have profit in inventory? Inventory is at lower of cost to market. You need to have inventory at cost. So in that case, you also need to eliminate that profit which is lying in the ending inventory of P in this case. So now, I know this sounds a little complicated, but what we'll do is, again, we'll follow the same 3 steps. We'll first look at the journal entries which have actually been passed by the sub and the parent. Then we'll look at what would have been the journal entries had they passed them as one economic entity. And then we'll have the eliminating journal entry. So when you have cash to sales here, so let me look at it again. Cash to sales $100 for S. COGS to inventory $80. So this is all good. The parent purchased inventory worth $100. Good. They made sales worth $150. Now what you need to change is this one. The parent, they sold 90% of the goods they had purchased for $150. So they had purchased the goods for $100. 90% of this is $90 for them. They are selling off 90% of this inventory. So they had purchased $100 and only 90% of this is sold. So 90% of $100 is $90, and that goes into cost of goods sold on the parent's income statement. Now we are looking at consolidation. We are looking at one economic entity. The sales to outsiders, that's been $150, all good. Cost to S was $80 for the entire inventory. What was the subsidiary's cost for 90% of the inventory? Entire inventory was $80. What is 90%? So that would be 90% of $80. So now we are looking at 90% of this number, which is $72. On the parent's books, the parent doesn't care about what's the subsidiary's cost. It cares about what's its cost. But when we are looking at one economic entity, we are looking at what's the cost of those goods to this entity. Here we look at the purchase price of S. S purchased that inventory for $80. And 90% of that inventory is sold for $150. What's 90% of that 80? $72. So this is what they've done on the subsidiaries books and on the parents books. This is what should have been done looking at it as one entity. So therefore we need to prepare eliminating journal entry so that we move from this to this. Now again, looking at cash. To the entity cash came in $150 and we have $150 here. The cash $100 which P paid to S, that's eliminated automatically because it's moved within the company. So it's all cool. Now when we are looking at, let's say, sales. Sales has been $150 to outsiders and you have that $150 out here. This sales of $100 which is there needs to be eliminated on consolidation. So we debit sales $100. COGS needs to be $72. What's COGS? COGS is 80 here and COGS is 90 here. So in total COGS is 80 plus 90. That's 170. It should have been 72. COGS actually, if you combine S plus P, COGS is 80 plus 90. It's be combining, right? So when you're looking at sales, it's 100 plus 150, 250. We're getting 100 off. When you're looking at COGS, it's 80 plus 90, 170. Should have been 72. You need to reduce this number by 98. Exactly. You guys have become good with your calculations. Now, let's look at inventory. Inventory, it's come in 100, debit 100 here, and the credit to inventory is 90 plus 80. So if I use the red pen for inventory, this is 80 and 90. 170 credit, debit is 100. The net credit to inventory is 70. 90 plus 80 is 170. Minus this 100 debit, 70 credit. How much should inventory have been credited? 72. So you need to credit inventory further by $2. So that becomes a part of your eliminating journal entry. If you recall, if all the goods which have been sold in intercompany sale of inventory have been sold to outsiders at the end of the year, the eliminating journal entry only had sales debit and COGS credit. The problem here is there was some unsold inventory and there was a profit in that inventory. We cannot have profit when we are selling inventory within the company. The inventory needs to be at cost. So guys, understand here. How much of the inventory is remaining? The parent purchased $100, inventory at $100, of which 10% was unsold. So they got $100, they sold out 90. So they had $10 of inventory. Now, S had charged 20% profit. They charged profit on the sale price. So this $10 of inventory in the parents' books at cost to the company should have been 10% of $8. Guys, understand, this $10 for the parent, the cost was $10 because the subsidiary did a markup when they sold the goods. So for the parent, the cost of these goods which were unsold at year end was $10. But the actual cost of the economic entity was only $8. So there was a $2 profit. That $2 is eliminated now. So guys, that is your eliminating journal entry. So we've looked at two things. Number one, we are eliminating the intercompany sales. Number two, we are eliminating any profit in ending inventory. And number three, if the sales and purchase happened on credit. So good thing here, you had cash and cash. How about this was accounts receivable and this was accounts payable? Can you have a receivable from yourself, a payable to yourself? No. So in that case, you would also have to eliminate the payable and receivable. And elimination of that was pretty much similar to what you did here. The payable, that's a credit account, so you would have debited it. The receivable, that's a debit account, so you would have credited it. Accounts payable to accounts receivable. Now this would have come into play only when there was sales. The transactions were happening on credit, not on cash. So guys, intercompany sale of inventory, once again, three things. Number one, you want to eliminate the intercompany sales and COGS. Number two, you want to eliminate the profit in unsold inventory at year end. And number three, you want to eliminate receivables and payables. So guys, three steps. Number one, what they've actually done on the parents books and the subs books, what they should have done had they been one economic entity. And once we understand this, it's very easy for us to do this eliminating journal entry. Get to page 16. Highlight intercompany sales of inventory. And in such intercompany transactions, you need to make sure that you have highlight elimination of the intercompany sale purchase. In such an entry, you're going to have highlight sales on the debit and COGS on the credit. You also need to make sure that you have highlight elimination of the intercompany receivable payable. On such an entry, you're going to have highlight accounts payable on the debit and accounts receivable on the credit. Now, if due to the intercompany sales of inventory, there's some profit in ending inventory, we need to make sure that there is highlight elimination of the intercompany profit in ending inventory. And such an entry would have highlight COGS on the debit and highlight inventory on the credit. Now, if you combine the journal entry for the intercompany sales purchase and the journal entry of the intercompany profit in ending inventory, you would have sales on the debit, COGS on credit, inventory on credit. And let's look at that on our example on page 20. Moving on to page 20, highlight intercompany inventory sales. And you have the journal entries in the books of the S company and the P company. So put a bracket there and write journal entries of P and S in the parents books and in the subsidiaries books. And on the right, journal entry of economic entity. Now that would have been the sale to outsiders only. So write cash debit 150 and sales credit 150. The cost of these goods sold is 90% of $80. So write the next entry is COGS debit $72 and inventory credit $72. So now that we have the journal entries in the books of the parent and subsidiary, and we also have the journal entry which should have been passed by the economic entity, we will prepare eliminating journal entry, which is sales debit $100, inventory credit $2, that's the profit in ending inventory, and COGS credit $98. Now we just looked at intercompany sale of inventory where we saw the subsidiary selling goods to the parent, which got eliminated because we're looking at one economic entity. Now had it been the parent selling goods to the subsidiary, same treatment, no difference. Guys, on the CPA exams, when they're giving you intercompany transactions, it's always that the parent owns 100% of the subsidiary. Now it gets really complicated in real life when the parent owns, let's say, 70%, 80% or 90% of the subsidiary and you have some non-controlling interest holders. That's when intercompany transactions get real complicated. On the CPA exams, they are as simple as this. And let's look at another simple intercompany transaction, and now we're talking about intercompany sale of PP&E, where the parent or the subsidiary is selling PP&E to each other. So this is So here we have subsidiary selling goods to the parent. Let's change it a bit and let's say the parent is selling PP&E to the subsidiary. Now that's all good as long as the parent and subsidiary are separate entities. So on the parent's books, it's a sale of PP&E. On the subsidiary, they've bought in PP&E. But the moment you look at them as one economic entity, you got to eliminate this. Cannot sell PP&E to yourself. So let's quickly look at the example and the journal entries. So you have P company sold equipment with historical cost of $600 to S for cash of $500. So P company's historical cost was 600, cash they got from S was 500. The equipment had an accumulated depreciation of $300 with the remaining useful life of 10 years. So guys, let's look at what were the journal entries in the books of P company, the seller of the PP&E. So they sold PP&E which had historical cost of $600 and the book value was 300 because they had accumulated depreciation of 300. So this went off the parents' books. They got in cash $500 for this. So they had a gain on sale of PP&E. So they sold PP&E which was on a book value of $300 for $500. They had a gain of $200 on this sale of PP&E to the subsidiary. Now look at the subsidiaries books. For them, this PP&E has come in. Now it didn't come in for $600, it came in for $500, the cash that they paid out for this. Now if we look at this as one economic entity, what should have been the journal entry for this? Nothing at all. Can't sell PP&E to each other. So we need to create an eliminating journal entry. Now if you look at cash, cash went out from here, came in here. So cash, all good. Now when you look at PP&E, PP&E had a book value of 600. Now it's become $500. Now you need to push it up by the $100. Accumulated depreciation on the PP&E, $300, that got eliminated, that got away. So now on the eliminating journal entry, you need to recreate that. Can you have a gain when you're selling PP&E to each other? No, you can't. Need to reverse this. So gain is credit, now need to debit it. So this becomes the simple, easy eliminating journal entry. Once again guys, 3 steps. Step number 1, look at what they've done. Step number 2, look at what they should have done. Step number 3, prepare your eliminating journal entry. Now a little trick here could be depreciation. Now that the parent has sold the PP&E to the subsidiary at a markup, at a gain, there would be higher depreciation by the subsidiary than it would have been had the parent not sold it at all. So if the depreciation amount has increased, we need to reduce it on the consolidated financials. So guys, because the book value here was $300, the depreciation that the parent would have been doing would be on the $300, let's say. But now the subsidiary is going to depreciate it at 500 base. So they're going to have a higher amount of depreciation expense than the parent would have had if the equipment would not have been sold. So need to reverse that. So if there is excess depreciation, you would need to reduce depreciation. And the other side of this journal entry is going to be accumulated depreciation. So let's say the equipment they're saying has got a remaining useful life of 10 years. So had the parent depreciated $300 over 10 years, they would have had a depreciation of 30. But the sub now is going to have a depreciation of 50. 50 minus 30, need to reduce depreciation by 20. So you're going to have 20 credit and a 20 debit here. So looking at two things. Number one, eliminate the sale transaction. Number two, look at the depreciation amounts. Is it the same as if the sale had never happened? Think about it. If the parent would have sold this equipment at a loss to the subsidiary, then the depreciation amount would have reduced. You would need to increase it here. So eliminate the transaction, look at the depreciation dollars. Get to page 17 and highlight intercompany sales of PP&E. Now this is not allowed because we're looking at one economic entity. So highlight eliminate the changes that resulted from the sale. So if you had a gain on sale, that would be debit. So highlight gain on sale of equipment. If it was a loss on sale, that would have been credited. And now the debit would be highlight equipment and the credit is going to be accumulated depreciation. And now we are also concerned about depreciation dollars. So highlight depreciation over the subsequent year. Turn to page 20 and on the second half of the page highlight intercompany PP&E. You have the journal entries in the books of the seller and the purchaser. So draw a bracket and write journal entry of P and S in the parent's books and in the subsidiaries books. Make a note there, journal entry of economic entity and write no journal entry because such a transaction is not allowed if it's one entity. So now we are looking at eliminating journal entry. So the first entry, the gain on the sale of PP&E, that's debited. You push up the PP&E account, debit it further and recreate, credit the accumulated depreciation account. You also need to make adjustments for any excess or lower depreciation due to the transaction. When we're doing this setup for the video shoots, I told my team that I need boat space of 20 feet. But they made me agree on 16 feet of boat space. And look at the issue that I have here. I've used my entire boat, intercompany dividends, intercompany sale of inventory, intercompany sale of PP&E, and I have just this much of space to teach you intercompany purchase of bonds. But guys, don't you worry. I won't let you down. I'll make sure I use every inch of space that I have here to make sure this concept sinks in. So we are now talking about intercompany purchase of bonds. So now let's look at the parent and the sub. And let's say the parent, they have issued bonds. So they've got bonds payable. And the subsidiary, they went out to the market and purchased back the parent's bonds. So the parent on their books still have bonds payable. The subsidiary has investment in bonds. But now the bonds which the subsidiary owns, it's something like the parent has bonds payable to the subsidiary and the subsidiary has investment in the parent's bonds. Guys, can I have a bond payable to myself? Can I invest in my own bonds? No. So the moment you look at them as one economic entity, you need to get the bonds payable off the books. You need to get the investment in bonds off the books. So let's look at the journal entries. We look at it in three ways, guys, 3 steps. Number one, we look at what happened on the parents and the subsidiaries books. What should have happened had it been one economic entity, and what's the eliminating journal entry which will make us go from here to here. So first we're looking at this example here. You have S company purchases $1,000 of bonds issued by P company at par for $950 cash. So P had issued bonds. So P company, they had bonds issued for $1,000. They got in cash 1,000 and they had bonds payable 1,000. Now S company, they went out to the market and purchased these bonds for $950. So it was an investment in bonds for them. So far, so good. But the moment you take them, you treat them as one entity, what should have been the journal entries? Okay, when they issued out bonds, this is fine. They could have cash to bonds payable. But when the subsidiary went out to the market and bought back the bonds which were issued here, that's like a company buying back its bonds, retiring them. So in that case, let's say bonds payable should have been debited for the $1,000. How much did they pay to buy back the bonds? $950. So now they had a gain. Let's say they retired these bonds, they had a gain on these bonds, $50. So these were the actual journal entries passed by them. This should have been passed. So what's the eliminating journal entry here? See, I told you I'll use every inch of the space that I have. Now, this is all fine. This journal entry is all cool. Now, when they're actually going back and buying the bonds, they should have debited bonds payable as one entity, but they debited investment in bonds. So now on the eliminating journal entry, we will debit bonds payable. $1,000. So this is taken care here. We need to credit this investment in bonds. It's been created now. You cannot have an investment in our own bonds. So we need to credit this. So we'll have investment in bonds as credit. So the debit was bonds payable 1,000 and investment in bonds is 950. Cash went out 950, should have gone out 950. So that's okay. There should have been a gain because they had issued bonds at $1,000. They went ahead and bought it back for $950. Gain $50. So guys, this is what they had done. This is what should have been done. And the moment you know this, it's very easy for you to create eliminating journal entries. So guys, with this, we're done with intercompany transactions. Again, remember the 3 steps that I follow. What has been done on the parents and the subsidiaries books, what should have been done as one economic entity, and create your eliminating journal entry. Get to page 18. Highlight intercompany purchase of bonds. So this is the case where bonds are issued by one of the companies and purchased by the other. Now you cannot have a bond payable to yourself or an investment in your own bonds. So highlight to eliminate the bond, we'll have highlight bonds payable on the debit and investment in bond on the credit. Now if there is any highlight accrued interest on the purchase date, we're going to have highlight accrued interest payable debit and accrued interest receivable credit. Now if the bonds had been held during the year and there would have been highlight an interest payout, then there would be a need to eliminate intercompany interest income. So the debit would be to highlight interest income and credit would be interest expense. Turn on to page 21. Highlight intercompany bonds. For the first couple of journal entries, draw a bracket and write journal entry of P and S in the books of the parent and those of the subsidiary. Now, looking at them as one economic entity, write journal entry of economic entity. The first journal entry, that would have been the same. Cash debit $1,000, bonds payable credit $1,000. And also write the second journal entry, which should have been, right, bonds payable debit $1,000 because they're no longer outstanding. Right, cash credit $950, they've been bought back for $950. and write gain $50. There's a gain on the repurchase on retirement of $50. And that is why we need to have eliminating journal entry, where we are debiting the bonds payable $1,000, crediting the investment in bonds $950, and also crediting the gain on retirement $50. Now this gain could be an ordinary gain, non-operating item, or an extraordinary gain. E of tide on our on tide, no C. So we've learned that we prepare consolidated financial statements when the parent owns more than 50% majority of the stake in its subsidiaries, such that the parent, they control the subsidiary. Now there could be cases where the parent does not own a majority stake but still controls. Now in such a situation, the parent may be required to consolidate even without the majority stake, and the subsidiary here is called a variable interest entity. Now before the parent consolidates such a variable interest entity where it does not own a majority stake, 3 conditions need to be met. And let me call the parent P company and the subsidiary where the parent is not owning a majority stake V company. So we're looking at P company and V company. I'm saying the parent needs to consolidate this entity where it does not own majority stake if 3 conditions are met. So you got condition number 1. The parent or the P must have some variable interest in V. So P has variable interest in V. Now what's a variable interest? So if P has, let's say, equity stake in V. Now we know this equity stake is not more than 50%, but some equity stake, that's a variable interest. If P has given, let's say, some guarantees for V, let's say we needed some loan, some debt, and P was the one who gave guarantees for that, explicit guarantees, that could be a variable interest. Or P gave some implicit guarantees when we try to get money from related parties. Again, that could be a variable interest. So equity, guarantee, or let's say P does not have equity stake in V, but P has provided a lot of loans to V, a lot of debt. That could be a variable interest. So that's your condition number 1, where the P or the parent has variable interest in V. Now if condition 1 is okay, then you look at condition number 2. And this condition is that V, this one, must be a VIE or a variable interest entity. And that's what we're talking about here. So V is a variable interest entity if it has insufficient equity. It's very thinly capitalized and it cannot operate without the additional support in the form of this variable interest which is provided by P. So guys, number 1, here V has insufficient equity, needs P's variable interest to survive. Number 2, the equity holders of V do not control V. Equity holders don't control. And the third point that you have here is that V has disproportional voting rights. That means voting rights are not proportional to the amount of equity. So these are general characteristics of variable interest entities. Now, as you can already guess, there's something not right here. So guys, if condition number 1 and 2 are met, then you look at condition number 3, which says that P must be the primary beneficiary of V. P is the primary beneficiary of V, and the focus here is primary beneficiary. Now, P is a primary beneficiary of V if P has the power to direct V's key economic activities. P has power to direct V's key activities. And P, they decide to absorb expected losses of V, or they would receive the expected residual benefits from V. Something which is true for equity holders, right? That's what I'm talking here. So P is a primary beneficiary. It directs V, it tells V how V should be running its company. Now P would be getting absorbing the expected losses if V has losses, and they would be getting expected residual benefits if V has excess gains. P absorbs expected losses of V, or they get residual. So we're looking at expected residual benefits from V. So guys, as you can understand what I'm talking here, I'm talking about a special purpose entity which is formed for the parent's benefit, for P's benefit. But let's say the P does not want, for various reasons, to consolidate that into its financials. P says, I don't own a majority stake in that special purpose entity. Why should I consolidate? That is why you have these rules here. Even though P is not owning a majority stake, it might not want to consolidate. It's required to consolidate if, number one, P has a variable interest. Number two, V is a variable interest entity. And number three, P is the primary beneficiary of V. So as you can understand, it's a special purpose entity formed and controlled by P for P's own benefit. In that case, guys, P is required to consolidate, and that is what we're looking at, variable interest entities. We're looking at variable interest entities on page 22. So right there, control without a majority stake. We're looking at conditions which are to be met by the P company in determining requirement to consolidate a V company in which it does not own majority ownership stake. Highlight condition number 1. Does P company have a variable interest in V company? And a few paras below, highlight example of variable interest, highlight equity ownership or explicit investment at risk, highlight explicit guarantees, implicit guarantees, highlight liabilities. If condition 1 is okay, then we are looking at highlight condition 2 and underline if condition 1 is yes, highlight determine if V company is a VIE or a variable interest entity. Now, a lot of content there, draw a bracket and write VIE if, so the V company is a variable interest entity if it does not have equity investors with voting rights or lacks sufficient financial resources to support its activities. Entities are presumed to be VIEs if the equity is less than 10% of total assets. VIEs have the following characteristics. Highlight insufficient level of equity investment at risk and cannot operate on its own without additional subordinated financial support in the form of variable interest. So for example, V company is a VIE if its total equity is insufficient to obtain bank loan for which it obtains a guarantee from P company. Here the guarantee is a variable interest and V company is a variable interest entity. Next, highlight equity holders have no power to make decisions or direct activities. They got no control. And the last couple of lines highlight some equity holders have disproportional voting rights in comparison to their economic interests. So guys, condition number 1, does P company have a variable interest in V company? Condition number 2, is the V company a variable interest entity? That is when we look at condition 3 on page 23. Highlight condition 3. Underline if condition 1 and 2 are yes. And then highlight determine if P company is the primary beneficiary of V company. So it says if P company has variable interest in V company and V company is a VIE, that's condition 1 and 2. P company is the primary beneficiary if it has highlight power to direct the activities of V company that most significantly impact V company's economic performance. Right, and highlight absorbs the expected losses of V company. Underline or and highlight receives the expected residual returns of V company. And then highlight to summarize, VIE is consolidated by the primary beneficiary, which is the enterprise that is exposed to the majority of the risks and rewards associated with the VIE or the variable interest entity. And now let's quickly look at the variable interest entity example that we have. It says giant company and little company start a joint venture Equal LLC to produce and sell chips. All chips produced by Equal, that's a joint venture, are sold to Giant. Investment and voting rights in Equal are, so Giant has made an investment of $490,000, but they have voting rights of only 20%. Whereas Little, they have just made an investment of $10,000 for which the voting rights is 80%. Now the question is, should Giant consolidate the results of Equal? So we're looking at highlight condition 1. Does Giant have highlight variable interest in Equal? Yes, Giant has a 20% equity stake in Equal. So that's a variable interest. Next, highlight condition 2. We're looking at is Equal, the joint venture, a highlight VIE or a variable interest entity? Yes, as Equal has disproportionate voting rights with only 20% voting rights to Giant, which has 98% investment, $490,000 out of $500,000 equity. So condition 1 is yes, condition 2 is yes. Let's look at highlight condition 3. Is Giant the highlight primary beneficiary? Yes, because all the activities of Equal are on behalf of Giant. All chips which are produced by Equal are sold to Giant. Now, highlight, since all conditions are met, Giant must consolidate the results of Equal. So guys, this is an amazing example where you see Giant consolidating the results of Equal even though it does not own a majority stake in Equal. Because Giant has a variable interest in Equal, Equal is a variable interest entity and Giant is its primary beneficiary.